Do you know what the most misunderstood portion of a mortgage payment is? It's not the loan portion, it's typically the escrow accounts. For both first-time homebuyers and for homeowners alike that have, had their home for a while, looking at that statement, sometimes they don't quite understand what makes up the escrows or why it changes. So that's why we decided to make our timely topic for March on escrow accounts. So let's dive in. First, it's important to understand what actually makes up your mortgage payment. So there's the principal and interest portion, which is typically if you have a fixed rate, that will stay the same. That principal, of course, is the loan amount that you've borrowed. The interest is the cost of borrowing that loan amount. And then you get to the escrows, which include your property taxes, which is set by the county, and then your homeowner's insurance, which you, of course, get to buy and determine and choose on your own. And then if you put less than 20% down, you may have mortgage insurance as well. And then just an overall picture of your total monthly housing payment, you may have an HOA payment as well. That obviously is not paid to the lender, but it's considered a total part of the housing payment. So with escrows, they're collected each month from the lender and then paid on your behalf when they come due. That homeowners insurance and property taxes, they tend to change over time. And so the reasons why is, one, property taxes. The assessment on your property every other year, counties will reassess the value of your home and probably change the property taxes based on that new assessment amount. And then of course there's mill levy taxes that are voted on each year that can also change that amount that is your property taxes. You can actually go to the county and look up what those mill levies are made of, just for your own information. And then of course property insurance. Unfortunately, here in Colorado, we see homeowners insurance has continually increased significantly over the last few years. And there's several reasons for that. Labor costs is going up, construction costs are going up, due to the natural disasters, wind, hail, and fire. That is causing premiums to increase across the board. And so that is changing everyone's premium, and then of course that impacts your escrows. So what happens when these amounts change or increase? The lender or servicer, they will pay out that bill when they receive it, no matter what amount it is. And then every year they'll do what's called an escrow analysis. They will look at what they have brought in each month from your payments, and then they'll look at what they paid out, and then they're going to determine if there is a shortage. And if there is a shortage, they typically give you a couple of options. One, they may allow for you to do a lump sum of that shortage to bring it back to being current and making up that gap of what they paid out versus what you paid in. Or they may allow you to divide it up over the next cycle of your escrows. And then of course they'll probably increase the actual escrow amount as well to make it so that they have enough to pay out for the next year, which may or may not cover the next bill as well. So that's how it happens. You may see your these escrows increase, and that's typically how or why. Now, not all lenders require you to have an escrow account. There's a lot of loan programs that don't. Some do, so you'll just want to make sure you understand the differences there and when you do have to have it and when not. But that's really comes down to a personal preference of how you want to handle those funds. The pros, of course, are you have a set payment that you can budget to each month. It will be paid timely by the lender. They're not going to miss that. They're going to make sure that those bills are paid. And then, of course, just that peace of mind knowing that it's being taken care of. And then on the flip side, when you have the escrow accounts, the cons, sometimes you just don't have as much control on that amount that is being charged or collected each month. And then also, if you don't have those escrow accounts, you have a large sum payment coming up, both for insurance and taxes. And so budgeting for that and making sure you have enough saved away can be something you have to plan for. Whereas when they escrow it for you, you already kind of have that forced savings built in. Of course, I would love to help you understand your own personal escrow account. If you have any questions, don't hesitate to reach out. That's what I'm here for. And until next time, hope you have a wonderful month. Take care.